Okay, great.
Well, I'll kick it off. Thanks for joining everyone who's here. This is the OZ's session. The best is yet to come. So we're going to start off with Scott Turner, who joined us last fall for an Opportunity Zone announcement and some of the work we're doing on rural recovery. So I'll turn it over to you, Scott.
Well, thank you, Max. I appreciate that. It's so good. It's so good to be with you all today, and thank you for this invitation to speak. You know, over the last 2.5 years, I had the great honor and privilege of leading the Opportunity Zone initiative. And as you'll hear from our great partners today, the Opportunity Zone initiative was revolutionary for our country when it came to helping people in distressed communities and those forgotten communities around America with new job creation, new businesses, new housing. And, you know, it's still a brand new initiative and a brand new tool, but I'm so grateful for the people around our country that banded together, all stakeholder groups from education leaders, entrepreneurs, business leaders, elected officials, people in both rural, tribal, and urban communities around the country coming together around the table to talk about, hey, what are some long-term sustainability strategies that we can put together? One, to help people to be lifted out of poverty, to create new jobs, to create new housing and new businesses and repurpose buildings. And, you know, I traveled to over 70 cities around our country, and not one time, not one city did I go to where when people came together cross-generationally, cross-ethnicity, cross-party lines, whatever it was, coming together to use this Opportunity Zone initiative to bring about generational impact was truly humbling for me. And, you know, we're not done. This is still just the beginning. And so we're still utilizing this privately led, you know, privately driven tool called Opportunity Zones in our country. And you'll hear from our speakers today of exactly how that's going. And I know when we had the White House Opportunity and Revitalization Council, the CEA, the Council of Economic Advisors, came out with a great report about the activity opportunity zones around the country. We have a best practices report that you can still see today of different projects, housing, businesses that have been done prior to today around our country. So we want to take those same initiatives, those same practices, and yet expand them and multiply them into operating businesses and new job creation and lifting people up out of poverty city by city. And so I'm excited for our panel today to hear about what's going on, the work that's not only taking place, but the work that will take place and how we can get better as a team of Opportunity Zone professionals and help our country when it comes to new business and housing and so forth and reporting. And reporting is very, very important to see exactly how and what the impact that's being made in Opportunity Zone. So I'm excited to hear about that as well. But coming out of the administration and leading the Opportunity Zone initiative, I'm even more excited now that we have this tool that we can continue to use to help and to build communities, cities around our country that haven't seen investment in decades, and to see people literally one by one family at a time, two at a time, be lifted not just out of poverty, but on a way to prosperity, a pathway to prosperity, new entrepreneurs and new business owners, and et cetera. So I'm excited about it, and I really look forward to this opportunity today. So thank you, Max. And having great privilege of introducing our panel and our speakers today. Next, we'll have Mr. Jeremy Keele. Jeremy is the managing partner of the Catalyst Opportunity Fund, and he's here to talk to us about impact measurement and reporting. So Jeremy, thank you, sir, for being with us. Take it away.
Great. Thanks so much, everybody. And thanks, Scott. Scott, I feel like I need a call with you, every day to get me fired up. That was inspirational. It's great to hear from you. So hi, everybody. Yeah, as Scott said, I'm a founding partner and managing partner of Catalyst Opportunity Funds. And I'm really fortunate actually to have as one of my co-founders and partners in this, Jim Sorensen, who is the host and the sponsor for the conference. So Jim's a longtime friend and colleague of mine, and I'm happy to have him in the fund with us. Catalyst is a private equity fund that is focused on community-driven real estate investing in low to moderate income communities around the country. As Scott said, we're initially focused on opportunity zone investing, and we've raised just shy of about $200 million for kind of our initial opportunity zone strategy. So we've been really, fortunate and grateful to be able to raise the capital that we have. We've deployed about 125 million of that to date across about 10 projects. Catalyst has very much a kind of a middle America, small market thesis. We're not really in the coastal kind of gateway markets. We're looking for opportunities in places like, Salt Lake, Tacoma, Washington, where we just closed a deal this week, Louisville, Nashville, Montana, among others. So that's sort of the geographic focus of the fund. We're actually getting ready to launch our second fund. We're looking at somewhere between $300 to $400 million in kind of our Fund 2 offering. We're going to launch that next month. We're going to kind of dual vehicle that. We'll have one vehicle focused in opportunity zones in a lot of the same markets we're in now, but we'll have a parallel vehicle that's focused on similar kind of impact-driven real estate opportunities, but outside of the opportunity zone. So, to Scott's point, I just wanted to spend a quick minute, just kind of introducing the impact strategy. And it's kind of fun to be at a conference that's specifically, focused on that, because we talk about this a lot. We feel like this is our big, key differentiator. And we feel like this is a group that really, kind of gets where we're coming from on this. But so this is very much an intentional double bottom line investment firm. We have a dual mandate to deliver, competitive, risk-adjusted, market rate returns to our investors. But we also have a, mandate to deliver, measurable social and environmental impact in our communities. We feel that that's keeping with the spirit of the opportunity zone legislation. People will do what they will with the letter of the law, but we wanted to really kind of reflect back to the spirit of the law and do what we think this legislation set out to accomplish. We think about impact, and this is a real estate investment fund, so we're not investing in businesses. Jonathan's going to talk about that as sort of a different strategy. This is really a real estate investment firm, and we've built capacity and a team around that strategy. And it's really interesting, I think, at least from my perspective, somebody who's been in impact investing for a long time, to think about how the built environment and real estate can have a positive impact in the community. And I think, a lot of us obviously are very familiar with affordable housing as kind of a, tried and true product type that people have been investing in for impact, for a long time. And there's a lot of tools that have been built out around that. But we think that that's just the beginning, and that there's really a lot of white space here in terms of investing in other, types of, other product types and other, assets that really can program a lot of community benefit into low to moderate income communities. And I'll kind of give you a flavor of what we're talking about and what we're targeting. The big categories of impact that we focus on through this built environment lens. Number one is affordability. Affordability is an issue in just about every community that certainly that we're in around the country. Not surprisingly, we have about 1,000 units of workforce housing that we've invested in, and we define workforce housing at somewhere between, what people who are making between 60 and 80% of the area median income can afford to live in. So 60 to 80% of AMI. We've got about 1,000 units of workforce affordable housing. We have about 300 units that we've invested in at a much lower price point, a 35 to 50% area median income target. So that's sort of the affordability strategy. The other big category here is access to services. In these low income communities, food deserts, medical deserts, education deserts, like what are the amenities, what are the resources, what are the programming that can go into our real estate to address some of those gaps. And so that's a big focus for us. Another big one is economic development. How can the built environment be used to support, low income, first time entrepreneurs, small businesses who are trying to grow their business in those communities? And so a lot of what we're investing in supports, incubators, accelerators that are targeting, in some cases, refugee owned businesses and entrepreneurs, low income folks, minority minority entrepreneurs, and others. Environmental sustainability is another big category of impact for us, and we think about this across a few different sort of vectors. One is adaptive reuse, so that's taking an existing building that you would otherwise scrape and send off to the landfill and then build something new. If you look at the environmental footprint of, or profile of doing an adaptive reuse, meaning keeping that existing building and just rehabbing it, it's something like the equivalent of running a net zero new build project for 20 to 60 years. In other words, you get the same environmental benefit that you would out of a net zero project, ground up development, for 20 to 60 years just by keeping a building that's already there. So we do a lot with adaptive reuse. We look at low carbon, build strategies, net zero build strategies, and strategies around energy efficient operations. The last category, diversity and inclusion. I'm really, proud of this for kind of the work that we're doing at Catalyst. If you look at commercial real estate generally, it's a pretty white, male dominated industry. If you look across our sponsor partnerships, so the developers that we work with in our different communities, 67% of them are female or minority-led development firms. So we're really proud of that statistic as well. Anyway, that gives you a little bit of a framework. I think, Scott, you're going to turn it back to me at some other point in the future to talk about impact measurement more specifically, but I just wanted to kind of, tee up the Catalyst framework by way of introduction.
Thank you, Jeremy. That was excellent. You hit a lot of great points. And when you talk about the spirit of the law, that makes me smile that, even outside of, being together all the time and being at a conference and hearing that, to hear you say that is the focus, to concentrate on the spirit of the law and not just the letter of the law, is very encouraging. So we will circle back to you in just a little while. So thank you, Jeremy, for your comments. Next, I have Isela Rosales, the Managing Director and Head of ESG and Sustainability at Bridge Investment Group. Isela, was so happy that you're with us. Please address the group for us.
Thank you so much. Really appreciate the opportunity to be here and to be speaking to the audience that is joining us today. I am based in the Bay Area, California, so greetings to all of us that are here from that area as well as from around the world. As mentioned, OZs is just such a large and growing area of our world today. It can be expressed in so many forms. There's been a lot of discussion about how execution can take place, how it can or cannot follow that spirit of the law. And for Bridge, it means a lot to us to actually stick to the premise of the spirit of the law, while of course following all the regulatory rules. We want to do what's best for the communities, for our investors, and ultimately bring to market a strategy that we feel can be replicated. At Bridge, we currently manage as a firm overall about 25 billion in AUM. In our OZ strategy, we're over 2 billion of commitments raised already to date, and it's currently being executed in a fund format. We're on our fourth fund today, just as a reference point. And we also believe that this is something, in building a program that's going to be successful, we have to have the right resources in place. We have a team that is currently 34 people strong that are focused on our Opportunity Zone Fund and development efforts. So again, it was important for us to have the resources there. And while we as a firm have been around for decades, many of the individuals that may know us know of our work, especially in the multifamily segment. And that expression is actually very strong also in the Opportunity Zone Fund work that we're doing. In fact, about 85% or more of all of the projects that we'll ultimately do in our Opportunity Zone Fund program are in some shape or form multifamily. And even within that, also an expression, as Jeremy mentioned, affordable housing is a critical component of a lot of the work that is most meaningful. And we at Bridge also believe in that. So we have across our projects a selection of them that have a dedicated portion, anywhere from 20 to 25% of the units that we build in a particular community will be dedicated to affordable housing. Similar to Jeremy, we look at it in the vein of AMI, area median income. And for us, we're typically targeting to bring housing that is below that 80% AMI threshold. Again, we feel that that target is important because it's often targeting the workforce of America that we often call at Bridge the missing middle. They are considered, quote, to make too much to receive housing that is typically supported by government subsidies, but clearly this workforce doesn't make enough money to live in often what's Class A or even Class B stock. Just to spend a little bit of time too about our program, what we've been doing, the markets that are of interest to us. As many of you know, there are 8,700, over actually 8,700 opportunity zones that were designated based on 2010 census data. And as the world saw, not all opportunity zones were created equal. So as you look at the landscape of what's available, Bridge has chosen to focus on about 40 to 50 submarkets. These are submarkets that we believe, have been markets that we've been in before. We're very familiar. We like to work with the community and find more opportunities to again, bring jobs, bring housing, et cetera, to continue to make that community a thriving one. The trends that we often are most attracted to, the attributes, really stem around how do we continue to support the household formation that is taking place in these communities. We also want to make sure that we are making a very positive impact on their employment. And also, a lot of our communities are going to be, as I mentioned, very multifamily centric, although we also want to support communities that are already starting to think of being very transit oriented. So really wanting to consider the live, work, play concept and build on that. So you'll see that our communities will often think about the housing side, the employment side, as well as that sort of life aspect with retail mixed use options. So among the areas that we're looking at, just to share a few examples, we've been doing projects up and down the West Coast. Vancouver, Washington is an area that we really like. It's a suburb of Portland, Oregon. A lot of individuals may choose to live there for the tax benefits, but actually are employed in the city of Portland and will do that commute. We also are doing very large projects in Sacramento. In our backyard of Salt Lake City, we've got multiple projects happening there across our various portfolios. Also doing extensive work throughout Texas, Florida, and all the way up to the Northeast. So we really want to try to capture a good base of geographies. And again, looking at markets where we think we could make a difference. We've already made a difference, particularly with our multifamily work. We've been known to do extensive value add work, and in many cases in our communities, also infusing social and community programming, which again will be another part of our story. Once we build the assets that we bring to the table in these OZ markets, many of them will also see a whole suite of programming that we want to be very targeted and serving the needs of the residents in that community. So I feel like I could talk for hours, but I want to make sure that I give time to the rest of my panelists. So thank you.
Thank you, Isela. We really appreciate that. And thank you to you and the team at Bridge for your investment into the lives of the people in these forgotten communities. And also, it's very encouraging to hear you say about the wraparound services and the programming as far as the social impact goes to lift people in those communities, not just from a work and live perspective, but from their life perspective. So thank you for that. We really appreciate it. Now I have our buddy, Jonathan Tower, who will address us. Jonathan is a managing partner at Arctaris Impact Investors to talk to us about the operating business side. And Jonathan, thank you for your diligence and the work you've done through the years. So why don't you take it away? We really appreciate you, sir.
Thank you, Scott. Great to be back here with you today. And give a quick background on Arctaris, but really I want to jump right into using opportunity zones to invest in operating businesses, because I think that's the reason that I was asked to be here. But quick background on Arctaris. We've been impact investing for 12 years now, with emphasis on revitalizing low-income communities throughout the US. We recently launched our 6th fund in this strategy. And our emphasis in investing is on private equity operating businesses and also infrastructure. And this is really only about 4% of OZ activity. The other 96% is real estate. And my friends Isela, Jeremy are doing a great job with real estate opportunity zone investments. We're just focused on that 4%, which is investing in operating businesses with emphasis on living wage job creation. Our funds have been public-private partnerships with foundations and state government agencies and the federal government and lots of cities in between. And these funds are public-private partnerships which are created as blended financing fund structures. The first such partner on our OZ platform was Kresge Foundation, which came in and provided a $15 million principal protection guarantee to the fund. And this operated at the fund level and the deal level. So in theory, if we ever had a transaction that went bad, the principal protection guarantee is there as a reimbursement mechanism. Think of it like insurance to reimburse the fund for that realized loss. As soon as Mullen came in, the state of Maine came in with a similar guarantee of its own. And then we also raised first loss capital, last money out capital from groups like the government of Cuyahoga County, which is Cleveland, the Erie Community Foundation, the Richard King Mellon Foundation, and many more. And our investments are all across the country, but we tend to invest a lot more in a dozen different states where Arctaris has these partnerships. We can invest in Idaho if we want to, but we don't have a principal protection program in place there. So we're much more likely to invest in Maine or Colorado, for instance. So these are all funds with principal protection buffers. So as I said at the beginning, if you take just one thing home with you today from what I say, it's that the OZ tax program works for private equity operating businesses very similarly to the way it works for real estate. And in fact, there are quite a few meaningful advantages to investing in private equity operating businesses. And these advantages, they both come from the standpoint of impact, because we're creating living wage jobs and we're basically activist investors in impact, and also in terms of driving higher financial returns. I'll take the impact piece first. We are investing in companies where we're not aiming to create minimum wage jobs. We're creating living wage jobs. We're adding workforce training, and we're focused on low-income communities where we can have meaningful improvements in the people's lives. On the UNSDG side, we will never invest in a company and say, all right, here's a list of 17 things that we want you to do, because we realize that company might not be able to survive us. What we do is we look for several pinpoint areas where we can trigger and require meaningful improvement in that company's practices. We invested a couple of years ago in a recycling company that, even though they were recycling, they were kind of a bad polluter at the same time. And one of our requirements was, okay, you're green on the way out, but you're green on the way in too. And so companies don't need to be perfect when they show up. We try to make them more perfect over the course of our investment and using our capital as the driver there. Investing in a company always raises a lot of questions, and I think it's easier to talk about this from the standpoint of an existing example. And we've done quite a few of these investments now, but I'll give an example of a company called Recaro Automotive. And this is a tier 1 manufacturer of automotive seating. It's the upgrade car seat for a number of Ford models, Porsche as well. It's a high-end, performance-driven driver's car seat. And before we did the transaction, the company had about 160 million of revenue and 7 million of trailing EBITDA. It was a subsidiary of a publicly traded company, a large global company that had decided that it would make financial sense to move all of the manufacturing out of the United States to overseas locations. And I'm not going to go off on a tangent about what that meant in general, but the management team said, we would rather that you not move our jobs overseas, and ultimately entered into a negotiation with their corporate owners and reached a deal to buy the company from the publicly traded owner. The only problem was they didn't have enough money to do it. So we partnered in the management buyout transaction. We put up roughly 20% of the equity, most of the money, but we bought 20% of the equity as a preferred equity security with a capped return, so that we get our money out like a venture capital transaction. We get our money out with a pref, and we get a preferred return before the distributions go to the common shareholders. And we're only 20% of the company, so most of the pie is still there for the company, the employees, and management. We effected the transaction, but there was one problem. The company was not located in an opportunity zone. We bought it at a very good price, in part because we were not able to buy the factory with it. The owners said, you can buy the company, but you have to move it. So we made lemonade out of the pandemic shutdown in the automotive industry and moved the company during the shutdown into a Metro Detroit opportunity zone. We created over 150 living wage jobs at this company. We've been leasing the factory, but we're just about to exercise our option to buy the factory as well. So that's an important point. We invested in the operating company, but since we're going to be there for 10 years, we're going to buy the factory too. And then the next thing says, okay, if we're going to own the factory for 10 years, why don't we own the utility as well? So we're putting in a 2-acre solar farm to power the factory. 3 legs of a stool make a cluster strategy like that much stronger than just, throwing a dart at a board and investing in a company. And, you might say, okay, well, investing in a company seems really hard because you have customers and people and machinery and stuff that breaks and all of these issues. Why would you invest in a company instead of investing in a very nice friendly office building that rents to easy tenants who don't break stuff and you don't have too many employees? Why would you do that? Well, from the impact standpoint, it's really the 150 jobs. We're creating living wage jobs. We're helping to revitalize a community that was starved for this kind of economic activity. But on the financial side, let's just give you an example. Let's say there's a 10-year hold in opportunity zones, and I invest in a company, and you wait 10 years, and 10 years finally comes around, and it's time to call an investment banker, and I'm gonna sell this company. But year 10, crystal ball, year 10 happens to be an awful year for the automotive industry. Nobody's buying anything. It's a terrible time to be trying to sell something. So then you stretch out, it's 11, 12, 13 years maybe before you sell it. The real advantage to investing in a company like that is you can sell it when the time is right. We structured this transaction to benefit from both opportunity zones and QSBS, qualified small business stock, which is a provision of the tax code that allows you to sell the company at 5 years and a day without triggering opportunities, without triggering a capital gains tax. So here, we're not saying that we're going to sell that company at 5 years and a day, but we are saying that we're going to sell that company when we think it makes sense to do so, both in terms of financial return and also in terms of making sure that the new owners will be able to continue the good work that we've been able to achieve on the impact side. You've got to have a great handoff at the tail end of this partnership with the company. So it could be year 5, 6, 7, 8, 9. Maybe it is year 10 when we sell that. But the key is that you can sell your investment at the time that you think is the right time to do that. And that can really be helpful in terms of your IRR, because everybody knows that selling at the wrong time is the last thing that you want to do. So we structured the operating business as a C Corp to benefit from the QSBS tax exemption. We bought the building and the equipment in an LLC so that we can get the depreciation tax benefits. And the two sides together provide a very nice tax efficient strategy for growing the business, but also driving better risk-adjusted returns for investors. And if people are interested in how do I do this, I want to buy a company. I looked at real estate, but everything in an opportunity zone seems really bid up already. But companies seem to be, well, they're not inflated because they're in an opportunity zone. I want to buy a widget manufacturer and an OZ. How do I do this? Please reach out. We're pretty accessible. Love talking about this. And it's a topic that's near and dear to our heart. So happy to shine the light on this other side of opportunity zones, and I'm hoping that it encourages some other investors to follow suit.
Excellent. Thank you, Jonathan. What a tremendous testimony of operating businesses. And I love how you talked about the living wage jobs and allowing people and helping people to far exceed what they thought could be done. And so thank you to you and your team at Arctaris, and a tremendous story about Recaro Automotive. And I like how you said that three-legged stool, you know, hey, why not buy the factory and the utilities too, right? And I like how you said, because now it's not just the economic side, but the impact side. We created 150 jobs in Metro Detroit. And that is, and I think Jeremy said it, and Isela said it, the spirit of this law and the spirit of this council is economic development, and yes, community impact, social impact, because people are what matter, or what's going to matter. So thank you, Jonathan. Thank you, Jeremy. Thank you, Isela, for the work that you're doing inside of your prospective companies and projects and initiatives. And I'll tell you, as your friend and partner in this, I'm very encouraged to hear this and to hear that work that is still continuing to be done. And I encourage everyone who's logged in and listening to our speakers today, and part of this discussion, that you would take this in and understand that you heard the heartbeat of every person about the impact mindedness that goes along with opportunity zones. The media is not going to talk about that. Hollywood is not going to talk about that. But the people that are on the ground we are telling this is about impact, and impacting the life of people for generations to come, long after we're gone. And the impact that's made will far outlast us. And that is the spirit of this. And yes, every deal has to pencil out. Every deal has to make economic sense. And as you can tell, they are still making sense, and people's lives are being changed. So thank you, Max. We really appreciate this opportunity. I'm going to turn it back over to you now.
Thanks, Scott. I think Jeremy mentioned earlier he might have a little bit more to share about impact measurement. So I might give you just a moment here, but I wanted to comment that that might be a great opportunity for us to sort of weave together something that Jonathan mentioned about not only tax efficient structures, but measuring the impact of living wage jobs, and what Isela mentioned before we kicked off the call, which is just how much she's been seeing going on in opportunity zones, because apparently some people are under the impression that nothing has been happening over the last year or so. As a bit of a background for anyone who's joining now or doesn't know me, I'm Max Seawright. I'm the Director of Communications at the Sorensen Impact Center, and my work in OZs has been our partnership with Forbes when we ran the Forbes OZ20 from 2019 to 2020, and been following up with some of our partners in the space and some of the research we did throughout the rest of 2020 and into this year. So with that in mind, Jeremy, is there anything you wanted to add to that question of measurement?
Yeah, sure. And sorry, I should have maybe covered this, more extensively in my initial remarks, but I'll be very brief, just touch on this, because I think this is kind of interesting stuff, in particular for the audience that we've got here. And, to Scott's point, this is again, in keeping with the spirit of the legislation, we authentically at Catalyst want to understand, how our investments are or are not moving the needle. So that was the kind of primary motivation for us putting, this framework together. But I think what we've been really sort of surprised, pleasantly surprised to find out is that, people really resonate with this, and that's true with, capital, with our developer partners, mayor's offices, kind of other key stakeholders. Like there is this, really sort of robust desire to, in a very data-driven, objective, kind of non-emotional, non-subjective way, understand what's happening in the community as a result of these dollars, kind of coming in. And so, and obviously with the, with the new administration and kind of some of the murmurings coming out of the administration about maybe wanting to, tweak the program to enhance reporting requirements and kind of, get a better sense of what's happening in these communities, we think we're pretty, we're pretty well aligned with that. And I'll just do this really quickly through the context of a case study. Jonathan, I think, did a nice job with his case study. Can I share a screen, Max? Is that is that kosher, or would that be?
Sure. I'll make that available to you.
Because I think this is kind of helpful to visualize. So this is a project that we're doing here in Salt Lake. So we're based in Salt Lake. The conference is in Salt Lake. So I thought this would be a good one to share. But this is a cereal mill building down kind of on the southwest side of downtown Salt Lake in a district, in an opportunity zone in a district called the Granary. And this is sort of the namesake building for the district. This old, granary silos building. And it's really, this is sort of what it looked like historically. It's a Depression era, structure. So it's a historic structure. This is what it looks like today. It's on the main kind of thoroughfare coming outside of downtown Salt Lake to the freeway. So this is kind of what you see today. We acquired the building, a couple of years ago. And really the business plan for this is to convert the existing commercial space into, headquarters for a refugee-oriented business incubator. So there's a business incubator model. It's been very successful here in Salt Lake. They are our anchor tenant. They're going to move into the space and really work with refugee entrepreneurs and small businesses to help them grow and scale their businesses. So we love the kind of impact profile of that, of having that as our anchor tenant. In addition to this, and here you can kind of see the full business plan. I mean, this is an architectural rendering, but this is kind of what we hope to get to. We'll have residential towers on either side of this. And I want to talk really briefly about sort of innovations in the capital stack and innovations in impact. And Jonathan really, I think, nicely touched on kind of how his fund and his firm has been really, I think, leading edge in terms of blending different types of capital in at the fund level. We're behind Jonathan in that respect. We're still sort of figuring out how to do it at the fund level. Where I think we've been more effective is blending different types of capital in at the project level. And frankly, to drive to deeper impact, you really have to be able to blend in concessionary capital down at the project level, at least in our experience. And so we look at, on the cap stack innovation side, we look at, low land basis, land. So, getting into a neighborhood early. Scott's, talked about these neighborhoods that have been disinvested in for decades and decades. That's a bad thing. The plus side of that is you can actually go in, if you're an impact-oriented developer or investment group, you can acquire some of these parcels at a low land basis. This particular project will use historic tax credits. We obviously have the OZ incentive in here. And something that I think we did that was really innovative here is we have a ground lease structure with a low-income housing tax credit developer that's building these LIHTC towers next to ours at a deeply affordable rent rate. And when you add all that up, this is a project that absolutely pencils. It's something like an 18% IRR, which over 10 years is one of our best performing projects. But we did that through a really intentional focus on both kind of innovation and the impact and innovation of the capital stack. And let me just show you how our kind of impact framework works really quickly. We have 3 tools that we use to do this. The first is a needs assessment. We go into a community, we look, and this I'm showing you one from not this project, but another. We look at socioeconomic data, demographic data, educational achievement data, medical data, things like that, down to the neighborhood level to really get a snapshot of what's happening in this particular neighborhood. So that's on the very front end of an investment. Following that, we do kind of an impact underwriting on the project, and we put the project through a scorecard, and we have different categories of impact. How committed is the developer to impact, diversity and inclusion, environmental sustainability, affordability, community engagement, things like that. And I think the real secret to our success is within each of these 7 categories, we've created subcategories that are scored very objectively, very formulaically. So rather than me scoring something and then Jonathan scoring something and it has, completely different outcomes because Jonathan thinks about impact very differently than the way I do, you can run through our scorecard because it ties into objective administrative data sets that the government, puts on their websites effectively. we're able to get to a very objective assessment of how impactful that project is likely to be. We score each project, which you can see down here at the bottom, out of 100 points. And we have a minimum threshold cutoff for deals that we're not willing to do because they're not impactful enough according to our scorecard, kind of impact underwriting. And then the other reason, and the other way that we use this tool on a go forward basis is we actually tie our, portion of our economics with our developer partners to their performance, their impact performance relative to this kind of, baseline benchmark. And we have some of our investors that have tied our economics as fund allocators, capital allocators to our impact performance. So it's both sort of an impact sort of snapshot of the potential of this project, but also on a go forward basis, we use it as a baseline to compare, actual kind of impact results. The third tool, not surprisingly, is an impact dashboard, which I can't show you because I don't have it live right this minute. An impact dashboard for each project that sort of has speedometer dials and fuel gauge dials and things like that, that reads out the impact according to 10 to 12 metrics that we've used for each project that we've invested in. So probably too long-winded a way of explaining that, but I wanted to give you a little bit of context and hopefully that's helpful.
That's very helpful. Thanks, Jeremy. Well, I'm going to put us in breakout rooms for 10 minutes, and let's go a little bit deeper on what's working, what's hard, what makes a good deal, and how do we measure it. Just a moment to put us in these rooms. We're in breakout rooms just now, so just a moment we can move you.
Vivian, I think you're assigned. Can you join the breakout room?
Well, hello.
Hello.
How's everyone?
Good, good. We were having a good conversation with Jeremy.
Oh yeah, yeah, Jeremy and oh, there's Isela too. Yeah, y'all had two champions. So is this a different breakout that we're in now?
So now we're back in the just the whole session, and I don't think we have
Excellent.
quite enough time to do another breakout, but would love to hear about the discussions you all had in your breakout rooms.
Well, Max, one thing that came out in our breakout is the rural opportunity zone. Because when you talk about opportunity zone, 40% of all eligible opportunity zones out of 8,664, 40% are rural. And we don't want to lose focus and sight on how we develop from an infrastructure standpoint, from an operating business standpoint, from an affordable housing standpoint, from a repurposing of tremendous downtown rural towns that have tremendous architecture and assets like rivers and hills and mountains, and how we utilize that in building out rural opportunity zone projects and businesses. And so Andrew and Gretchen from North Sky gave us a great example of how they're using opportunity zones from an investment standpoint for renewable energy, fuel, agricultural fuel, taking agricultural waste and turning it into fuel. And so I thought that was very fascinating. And our friend Chantel from Colorado, who deals from an economic development standpoint, raised that question. And so we had a great conversation surrounding that.
Thanks for sharing. Did anyone else touch on rural opportunity zones or like to share anything else?
Yeah, so our session did. I'm actually personally working with a community in Upper Peninsula, Michigan, and Jonathan with Arctaris, obviously Michigan connection, but has done work in that area. Also in Southwest Colorado with the tribal communities, the Southern Ute community here. So we talked a lot about the interest. Obviously, things started in real estate, but the innovation is around new tech, new ideas, and bringing money into these communities and having it be place-based, based on the local resources, like you mentioned. And so the potential for venture capital, more patient capital, and getting the community to rally around these startups is really exciting. And then obviously on Jonathan's work in the infrastructure side, so combining that, combining the technology with the new infrastructure development and all the blended finance that's possible, along with the opportunity zone equity piece.
Thanks, Jason. We were able to profile some work being done in Southwest Colorado, so that's really fascinating to hear. And the rural element keeps showing up in a lot of our work, including some of the higher ed work we've done. And there's been some interesting things done with even university housing and opportunity zones, and we've been able to partner a little bit with the Center on Rural Innovation to talk about a few of these things. Curious to hear what came up in the other breakout sessions.
Hey, Max, before we move on. Hi, everyone. I'm at Sorensen, and we're actually doing a project around rural economic development on OZs. We're developing a playbook with a grant from the EDA that we introduced with Scott a few months ago, but I've taken down some of your names, but if any of you are working on that and would love to connect with us or with you, I'd love to get your emails and I'll follow up with Max on those, but feel free to chat me as well. So we're just in the research and development phase of that right now.
Excellent.
Thanks, Megan.
Hey, Max, one point that I did want to raise is one thing that we need to remember, or that I would encourage everyone to remember. And Jonathan talked about the public-private partnerships. One thing that we have seen bring a lot of fruit in opportunity zones is all the stakeholders coming together. And I alluded to it in my opening remarks, and how you have the Economic Development Corporation along with the entrepreneurs and developers and the funds, resource managers that come in, because a lot of times the opportunity zones, it literally takes a team, to make a project or a business or a real estate transaction, to make it happen and successful. In particular, in the smaller towns and cities. And so as we discuss here at the end of our time, just to remember that, all stakeholders involved in bringing partnerships together has been very fruitful in the days and months past, and also right now.
I'm glad you brought that up, Scott. I think that's one of the key pieces that people like Alex Flaxbart at Opportunity Alabama are trying to contribute is help be the platform that connects the different stakeholders and gets the community investors and the people who know on the ground where investment could be useful in a rural community or a mid-sized town. So it's been interesting to see their work, and I think they're going to have some interesting announcements come out in the next few weeks. So encourage anyone who's not familiar with their work to keep an eye out.
Excellent.
One thing that we find often in both urban and rural communities is that a lot of the elements for revitalization are already there. There's a foundation that is committed to doing something. There's a government that's committed to doing something, and hopefully a company that wants to do something too. And in those situations, there's a role for an impact investor to come in and say, hey, like, we can pull this together. Like 1, 2, 3, 4, 5. This is a blueprint. You go here, you go here, you go here, and then they all come together. I was telling our group, we did a very high level social impact program in Maine with the largest employer in Franklin County that shut down 6 years ago, and it cratered the local economy. The employer happened to be a ski mountain, which doesn't sound very impacty, but when it shut down, it ruined every other business in the area. 50% of the kids were on free student lunch. I mean, there was inner city poverty in rural America, which is a very persistent theme these days. And 3 different private equity groups had looked at buying it, but they couldn't get it to pencil out because it just didn't pencil out as a deal. Foundations tried to get together and do it, but they couldn't get enough money. And the government, kind of same situation, but pulling all the interested parties together into call it a coalition of the willing. We did it. We bought it 60 days before Vail shut down for the entire season. We didn't know the pandemic was going to be as real as it was. But we reopened it and had a good first season, and like, people are back to work now, and that was the main goal, like offering an entire community an alternative to buying one-way bus tickets to Tucson, Arizona, where you can all sign up as happy Uber and Lyft drivers. So I mean, the point was keep the community intact instead of letting it die a natural death. Darwin's not so good with communities.
Just to leverage that point, one of the topics that came up in our breakout is, if we just think about what happened in 2020 and COVID. I know we haven't really spent much time here, but for a lot of OZ players, it was in many ways a life or death, whether they continue to be participants in the marketplace. And at Bridge, I mean, it would be hard for me to say it was easy. It continued to be hard work. Scott, you mentioned, it's a team. It takes a team. It takes a village. It really does. I mean, I mentioned that we're fortunate to have built a strong team of 34 people that are doing this as their full-time day job, and that's not even counting all of the partners we have. So in our transactions, we do partnerships with outside developers. So if I start to bring them into the equation, we're talking about hundreds of people that are behind all the work we're doing. And when we got hit with the headwinds of the pandemic, I mean, it touched on everything. First and foremost, it hit financing, it hit construction, it hit, what do we now put into our underwrites to still make everything pencil out? And then, of course, there's a whole fundraising side of things. But even before we could get there, we had to make sure the rest of the pieces were still working and could work. And we definitely didn't want to be that player that came in strong and then faded. Like, we wanted to still figure out a way to continue to put money to work, get our projects financed, continue with our plan of building homes and bringing jobs, et cetera.
Good. Thank you.
Hey, Scott. I don't know if you're taking comments from the peanut gallery. but just thought, on just the evolution of OZ, because we did talk about interruption. And look, if you look at how the sort of the legislation was rolled out, it was all done with intent, right? The idea was to try and help those who needed it most. Truth is that the early days, folks jumped into the void here, in many cases for the wrong reasons, right? It's been basically was tax driven. A lot of folks who didn't bring real estate background jumped in the mix, and sort of had the risk of maybe getting steered down the wrong road. And despite folks who were put in place, there's a group called the Governance Project, and that some of you folks may be aware of, who tried to sort of steer money to good places. It just was unclear sort of where this was all going to go. So in some ways, COVID, my sense is that everything was put on hold from an investment standpoint for the most part. Capital has sort of been taking a deep breath, and it'll be interesting to see sort of in the wake of things sort of get back on their feet again, whether or not there'll be more thought given to the proceeds and these resources being steered to the places that they were really truly intended for, right? Whether it's rural or urban. Right. And will folks step in to sort of be more regulating in terms of how capital gets deployed? Because it was all done, like I said, with good intent. Just you hate to see folks who have sort of taken advantage of things for the wrong reasons.
Right.
So, curious what you.
No, and obviously that's a great observation. And what we saw, and obviously we were keeping a very close eye on this, during our time in the administration, and even more so now. And I would say, and if you hear and listen to the presenters, even just today, and with Jeremy and Isela and Jonathan, and how, the people that are taking the real investment inside of these neighborhoods understand the spirit of the law. And what I've seen, just around the country and having feet on the ground, is that the money is being dispersed at a very high level and rate to the places that actually need it. And obviously, when the initiative first came out, yes, there was bad actors, there was bad Cs, as in any time you have a tax incentive. But I think that through the time and through the years that those, and I can't say all of them, but have been weeded out, and that the investments that are being made are actually going to the places, and even in a more creative way now that the initiative has been around longer, going to places where it's actually needed. We had the folks from North Sky that were telling us about how they're investing in rural opportunity zones by way of agricultural waste and creating reusable fuel and energy and jobs. And so that's what the intention is to touch the people in the country, in rural, tribal, and urban areas that have been disinvested in and that are underserved. And so I would say now that there's a greater focus on the money and resources and projects going to the places where it's actually needed and making an impact, both for those that are in the community and also for those that are invested in the community.
Yeah, really encouraging, right? You just hope it pervades, the present companies all bought in, right? These are folks who are drinking Kool-Aid. The question is, do others sort of follow suit, right? Do these become trends? I'm with you, man.
Right, we have to keep leading well and hope that those that come behind us will follow suit.
Amen, yeah.
Thank you for that.
I'll just say, because I think Dave raises a really interesting point, just on the real estate side. I think it's just becoming increasingly more difficult to do impact in real estate because, asset values have just gotten, so expensive, so high. And then when you look at the cost of construction, right, with commodity prices where they're at, labor prices, like it's just really tough because, to go build something or renovate something, it just requires an enormous amount of money. And it's hard to make impact projects pencil on that basis. And that was my point about, needing to blend in other, types of subsidies. I think what we covered, one of the things we covered on our breakout is, you can't really get there with the OZ incentive alone. That's not going to close the financing gap. You need, tax increment financing. You need, government contributed land in a lot of cases. You need other government grants. Tax credits. I mean, it just, you have to get kind of creative and resourceful. And there's just, this to Dave's point, like we're all drinking the Kool-Aid, we all take it seriously enough to want to do that. But, the large majority of groups out there are just not going to bother. And so it's going to be increasingly tough to get, impact projects to pencil over time.
Yep. Jeremy, let me ask you, so we all have this once in a lifetime opportunity with the American Rescue Plan dollars that are coming. Are you thinking through or connecting with the people who are going to be handling billions of dollars very quickly? So in Colorado, we're prioritizing housing. So billions of dollars are going to be going through local governments for affordable and workforce housing. I haven't heard anybody talk about, and I will bring this up with our partners, but I haven't heard anybody talk about marrying those investments in workforce housing in opportunity zones.
Yeah, I mean, somebody should take that up. We've talked to our Speaker of the House and our Senate President here in Utah. I think Utah is going to get about $2.5 billion total from ARP, which is meaningful for a state of Utah size. So, it's top of mind for us because we control critical mass in some neighborhoods where we really could benefit from some infrastructure. And those ARP dollars are really, geared towards infrastructure. So yeah, we've been having those conversations, at the local level. But I haven't seen anybody sort of spearhead a kind of, strategic initiative around this. And really without somebody like Scott in the role that he was in, previously, I don't know how you get that kind of interagency, cooperation and buy-in, but that's kind of what you need to, figure that strategy out.
It's funny. I think there's even fundamental risk, Jeremy, just on the real estate side. Again, a lot of into this merely by virtue of the tax opportunity. Folks necessarily didn't real estate shops. At the end of the day, man, this is all still about real estate investing, period, right? Just sort of a creative structure that you overlay on those skills.
Yeah.
My hope is there may be some that sort of, again, who came with sort of wrong intent, wrong backgrounds, may sort of create some choppy waters, in the space. But maybe what it does is clears the deck, for those who really should be sitting in the seat and doing it, like I say, for the right reason. But just interesting to see how this all evolves, right? Maybe COVID exposes some of those people.
Yeah, and I think, Dave, to your point, I think the sort of the next evolution of this is, we've talked about blended capital stacks. It's the kind of stuff that Jonathan's doing, where you take government money in at the fund level and you blend it with private capital to get to these really impactful investments that are otherwise not going to pencil. It's just, I think about it in terms of market failures. If the private sector could go out and solve these problems, if the private sector could solve the affordability crisis, it'd be on its way to being solved right now. It's clear to me that there's a market failure there. And so, government's got to step in. Chantal, you're talking about, ARP dollars in Colorado going towards affordable housing. Like, that's the kind of thing that we have to start thinking about, because it's just, there's no pure private sector, solution to this. It's got to be multiple sectors coming together, and philanthropy's got to play a part, and impact investing and everything else.
I couldn't agree more with Jeremy. I mean, I think outside the impact space, you'll see opportunity zone funds that are making doable deals better. The deal was doable without the tax incentive, but it just got better because you got, some special, bonus tax considerations. I think in the impact space, we're arguably doing transactions that are, deeper in the murky, will this deal ever pencil out or not? And in a lot of those situations, opportunity zone, that tax incentive, the NPV of the tax benefit is not enough to get that deal fully qualified. So being able to bring in federal, state small business credit initiative or Rescue Act funding or community development block grants or Section 108, I mean, the list goes on. Those are additional tools in creating the 17-layer cake that is needed to solve some of these really deep down, nitty-gritty, hard economic development challenges for these communities. Right. I see Jeff is on, so I think the hook came out. Hi, Jeff. Are we are we out of time?
Just wrapping up.
Okay, great.
Excellent.
Well, I think that's as good a place as any to wrap up our discussion. Thank you again to everyone for your comments, and it looks like we have a lot to keep our eyes on and pay attention going forward in opportunity zones. In just a few minutes, the live session will start up again for our final remarks. So look forward to seeing you all in the Slack, and thanks again.
Great.
Hey, Max.
Have a good day, everyone.
Thank you, Max. Thank you,
Thank
Scott.
you so
Great.
much. Thank you, everyone. Nice to see you.
Great to see
Sorry,
you.
Scotty. Scott,
Hold
are
on.
you making a last point?
Yeah, but it's okay. You can cut me off anytime.
No way.
It was
Okay,
great.
Good. That's because you're all great. Okay, we're going over to the main stage for the closeout. Thanks, everyone.
Thank you, Jeff.